Ready when you are.
Hi, everyone. Welcome to this episode of the Immigrant Doctor Podcast. I'm your host, the Immigrant Doctor, Dr. Avishkar Sabharwal. So, we've talked so much about the tax benefits of real estate, and I'm sure you've heard it enough number of times. But really, how do these tax benefits apply to you, and how can you take advantage of this? For that, you really need to conduct something what's called a cost segregation study. And I'm here with Yonah Weiss. He's actually a cost segregation expert, and we're going to dive into this topic of how you can get benefit from real estate specifically for the taxes that you're paying to the IRS. So let's dive in. Yonah, welcome to the show.
Thank you so much.
Yeah, so let's start with your journey. What got you started in this sort of, I would say, boring field of cost segregation where you're running the numbers, going through all the data. What got you started in this?
Thank you so much. It's always good to know I'm doing something very boring. It really wasn't something that I wanted to do when I was a kid, grow up and be a cost segregation expert. But I was a teacher for many years, and only later, kind of 15 years into my teaching career, I found real estate. And like many other people, when you have one career and you find real estate, you're like, oh, how can I figure out how to do this more actively? Which I did. And so over the past 8 years or so, I have been I left the teaching field, well, informally, because I'm still teaching this, cost segregation subject every day, and went into real estate. Did a little mortgage brokering. I just kind of got my feet wet. Got my real estate license. Figured, I could learn everything and anything there is to know about real estate and figure out what I want to do. And little by little, I did some fix and flips. Brokered mortgages. Did some brokering of properties, etc. I felt like it wasn't really my place. I didn't find real joy from most of those things that I was doing, but because teaching was always been my passion. And then I was approached by this company, Madison Specs, Madison Commercial Real Estate, the biggest national cost segregation company. I knew very little about cost segregation, which surprisingly, I went and started asking everyone that I knew about cost segregation. Hey, do you know this? And even all the real estate investors, 90% of them, or plus, more than 90% of people that I knew had no idea what cost segregation was. So that to me immediately gave me kind of like an epiphany that, hey, this is a subject that is kind of clouded in, confusion, and an opportunity for me to just use my teaching abilities and share this subject with the world. And in the meantime, I was still investing in real estate more passively, and learned networking, and that just kind of grew my network tremendously. Opened up many more opportunities for me to being the cost segregation king, being the one who people think of when they think of cost segregation. It's really been an honor.
I love it, cost segregation king. So let's just dive into what cost segregation really is. I mean, we've talked so much about what it can do, but let's dive into the nuts and bolts of it. What really is a cost segregation study?
So essentially, it's a tax strategy. Okay, you have to think like this. It's an income tax strategy, which is a cash flow mechanism. So if you think about it in that context, then understanding kind of the nuts and bolts and how it works makes a lot more sense. Because you started off saying we hear about the tax benefits of real estate investing. Well, this is the main one, because there's something called depreciation, and cost segregation is just an advanced form of depreciation. Now, depreciation is not what it sounds like. It's just a borrowed term. It doesn't mean that your property is going down in value. What it is, it's a name of a tax deduction based on the principle that things go down as time goes on. So essentially, when you buy a property, besides for your primary residence, if it's a rental or business property, you're able to literally write off the entire value of that property over a long period of time. Okay, that's called depreciation. So you take a little bit of a deduction every single year over a 39-year period, or it's a 27.5-year if it's residential. But that's a long time, right, to kind of take those deductions. Cost segregation, like I said, is a tax strategy. It's a cash flow mechanism that allows you to accelerate the depreciation of certain components in the property and taking bigger tax deductions up front. Okay, so think about it like that. It's just a way to pull from that pool of potential deductions, and let's say take 20, 30% sometimes up in the first year or the first few years. So again, I have not yet even spoken about what cost segregation is, right? How it works, what the nuts and bolts, but essentially
let's talk about the depreciation part, right? So we just said that it's not really decreasing in value, and I think when somebody hears the term depreciation, immediately you get a sense, well, wait a minute. Usually, I've heard historically real estate goes up in value, and now we're talking about it going down in value.
Exactly.
So I think just to clarify for our viewers, depreciation is sort of the way the IRS looks at your product or your asset that you're buying, your real estate, that it thinks that because of the wear and tear, some of the aspects of that real estate are going to be depreciated. So you'll need to replace them. And that's why you're able to take those depreciations off, even though overall the value of real estate may increase over time. Am I correct in saying that?
So in a sense, yes, that's how the IRS views it in terms of why they allow to take this deduction. However, it's really just a borrowed term because it's not intrinsic in the property, because this depreciation deduction is subjective to the owner, meaning it starts over every single time the property changes hands. So you're absolutely right. Yes, certain things have wear and tear. You're going to have to replace the roof over a certain, in 15 years or whatever, right? So it has a certain lifespan. You're going to have to replace the carpeting or the flooring, whatever, every 5 years or so. So the IRS gives it a 5-year lifespan. However, if you buy this property, do not replace the roof, and then sell it 5 years later, that new owner gets to start the whole schedule over fresh, as if it's starting brand new and it has a brand new depreciation schedule. So in a sense, yes, that's the principle that it's based upon. But the reason why I say it's just a borrowed term is because it's totally subjective to the owner. And that's the real benefit of this, because we're able to literally write off the value of our property and all the components within it, even though they may be actually going up in value.
Who should consider? I mean, on paper, it seems like a great thing, right? You can write off so many things on taxes, but then who should consider it? Is it a good thing for everybody to do, or there's a certain subset of properties that you think are, better for a cost segregation study? Because, it is expensive. It's not cheap.
Well, yes, it definitely costs money to get a cost segregation study done. It's more about who the person is rather than the property. Yes, there are certain types of properties that are better. So what we're doing in a cost segregation study, just to kind of break it down first, and then I'll answer those questions, that we are, like I said, breaking down the components of the property and saying certain things depreciate on a 5-year schedule or a 15-year schedule, as opposed to that longer 27.5 or 39-year schedule. So by doing that, we're saying the personal property, stuff that's non-structural, like I mentioned, carpeting or flooring, appliances, furniture, fixtures, anything that's inside that's non-structural, all that depreciates on a 5-year schedule. And oftentimes that could be, 20% of the property is literally in those components, which means you can literally write off in 5 years, 20% of the value of the property, as opposed to just taking a 2 to 3% deduction every single year. Now, who should be doing this? Like I said, it depends on the person. Because depreciation is not equal, unfortunately, meaning the real estate is taxed differently. Now, many of our listeners may be medical professionals, right? And maybe people who have high-paid W-2 jobs and are thinking of ways how can they reduce their taxes. And real estate can be a good form of that. However, it's going to be limited because the depreciation is only going to be limited to offset your passive or rental real estate income. And so you cannot use it to offset your high-paid W-2 income, unfortunately, with a couple of exceptions. And I'd like to touch on a couple of those exceptions because they may apply to many people. But generally speaking, regardless of the property type, it's more about the person, if the person themselves can actually use those deductions to offset their active income besides for just their passive income. But in terms of the property types, and I'll get back to those exceptions in a minute, but the property types, those types of properties that have more interior components or fixtures or amenities, like for example, like a single family short-term rental, which is a great example. You have a lot of furniture and fixtures, etc. There's going to be a lot there. A bad example, or an example that has very little, is going to be like a warehouse, right? You can do this on any type of property, whether it's residential or commercial, but a warehouse, there's very little inside. You may have some exterior, what we call land improvements, depreciating on a 15-year schedule, like a parking lot, the asphalt, concrete, landscaping, etc. But interior, it's going to be very low on the spectrum in terms of the tax benefits intrinsic to the property. Generally speaking, about 20 to 30% of the property can be reallocated into this faster depreciation schedules for many, many types of properties.
Okay. All right. Yeah, that makes sense. But in terms of, this tax depreciation that occurs, of course, it came into a lot of favor recently because of the bonus depreciation that was being offered, right? And so I want to touch a bit upon what was bonus depreciation and the fact that it's going away. How do you see the landscape changing in terms of people doing cost segregation study versus not doing cost segregation study?
Sure. So back in 2017, there was a big tax reform, and that introduced this thing called 100% bonus depreciation, which essentially said once you've done a cost segregation study and have allocated certain of those components to a 5-year or 15-year or 7-year depreciation schedule, you're able to take 100% of those deductions in the first year, as opposed to just spreading them out over a relatively faster schedule. You're able to take a huge amount up front. So that was big. Although when they wrote that law back in 2017, they said it's only going to apply through the year 2022. So if you bought a property between 2018 and 2022, you're able to take 100% of that bonus depreciation in the first year. This year, 2023, at the time of this recording, it's gone down to 80%, which means you can take 80% of those accelerated deductions in the first year, and then it's going to continue phasing out by 20% each year. So next year is going to be 60% if you buy a property in 2024. And again, I'm saying it goes after when you buy the property and not when you're filing the taxes on it, which is a great thing. You can actually do a costing on a property that you bought back in 2018 or 19, 20, etc., and still claim the 100% bonus depreciation this year, even if you haven't.
Oh, really? That's interesting. Hold on for a minute, because this is very interesting. I did not know about this part of it. So if somebody bought a property, say last year, when they could get 100% bonus depreciation, can they get it this year if they're filing their for their taxes next year, or does it have to be only for the 2022 taxes, the tax year, that they can get the bonus depreciation to 100%?
They can do it this year. So it goes after when the property was purchased and not when it was filed. So you can do a cost segregation study on a property that you bought in a previous year, and you don't even have to amend your tax returns to do that. We just catch up the misdepreciation.
Oh, that is very
forward.
interesting. So, I mean, that I guess there's hope for people, who've bought this property in this opportune time, but they did not necessarily know about cost segregation, and they want to do cost segregation now for their subsequent tax year. They can actually catch up on it then.
Exactly. Yeah, it's a huge opportunity. And in fact, it may be, for certain people, like I said, it's a tax strategy. So it may be more advantageous to wait to do the cost segregation and not get it done in the first year anyway. So yeah,
let's talk about that. How is it going to be advantageous for people to not do it in the first year versus do it later on?
So there are a lot of factors, but one example would be if you just, I mentioned earlier, if you can't use those tax deductions, right, getting more deductions and not being able to use them really doesn't do you any good, right? It's going to create a passive loss. You'll be able to carry forward. You can use it next year, but using it in the current year is really going to be when it's most advantageous. I mentioned earlier there are a couple exceptions to the rule of this passive losses, offsetting passive income versus active income. One of those exceptions is something called a real estate professional. So if you or your spouse are full-time in real estate, you can use these deductions against your active income, against your W-2 income, as opposed to just offsetting your passive rental income. There's a perfect example of why you shouldn't get it done in 1 year versus another year. Let's say you bought a property back in 2022 and you're a full-time doctor, right? And your spouse is as well, or another high-paid W-2. And if you were to do the cost seg then, you'd just be creating these deductions, these losses you wouldn't be able to use. But if in 2023, let's say, or 2024, for argument's sake, one of you became full-time in real estate and got that real estate professional status, it's better to wait to do the cost seg at that point, and then you can use those deductions against your active income.
That is very interesting. That is so cool. One more thing regarding this, is the fact that a lot of short-term rentals got a lot of push in the last few years, right? Especially with the COVID, pandemic and everything. Everybody got into the short-term rental market. I've seen that short-term rentals are sort of coming, not necessarily phasing out, but the market it's become more competitive, and it's, the returns are slightly lower. So if somebody is, say, transitioning from a short-term rental to a long-term rental per se, how does that affect the cost segregation per se? Is it a completely different cost segregation for a short-term rental versus a completely different cost segregation for a long-term rental, and they work independently, or is it the same?
It would be a slightly different. A lot of the times it has to do with who owns the furniture and appliances and all that stuff. Because again, if you own that and you're the property owner, you're able to depreciate those things over a faster period of time. Whereas if you just own, a long-term rental and the tenants bring in their own stuff, their own appliances, there's going to be much less depreciation for you to accelerate. The biggest difference between the short-term rental and long-term rental, which is another reason why a lot of people started doing it over the past few years, not just because of the pandemic, really a lot because of this 100% bonus depreciation thing. Because there's a special rule with short-term rentals, which is one of the other exceptions that I mentioned earlier, whereas if you have a short-term rental on Airbnb, the average stay is less than 7 days, and you self-manage it, okay? So you cannot have a property manager, but you're self-managing and doing what's called materially participating, so you have to spend a certain number of hours. You can actually then use the depreciation from a cost seg to offset your active income as well. Meaning you can, without having to be a full-time real estate professional, which is a much higher, we didn't talk about the rules there, but much higher threshold to overcome. The short-term rental, we call it the short-term rental loophole. It's not really a loophole. It's directly in the tax code. But what this says is that if you have a full-time job, as long as you have one rental that's a short-term and you self-manage it, you can then use depreciation to offset your W-2 income as well. So I think that's another reason why it's gotten so much attention over the past few years. But like you said earlier, now with bonus depreciation phasing out, it may be another reason why people are going to,
Interesting. Yonah, before we move on, let's just talk about how people can reach you and, get in touch with you in case they're looking for a cost expert or the Cost Segregation King.
Yeah, absolutely. You can find me. I'm very active on all the social platforms, especially LinkedIn. Most recently in Twitter. There's like a real estate tool. Now it's called X, but this other platform over there. And this Instagram, Facebook, wherever you want to find me. Yonah Weiss. Weiss Advice Podcast is also very popular. Feel free to reach out. You can also go to my website, YonahWeiss.com.
Very cool. Yonah, so, we've talked a lot of theory about it. Let's just talk about some numbers. Say you've done a cost segregation study in the last year where people had this bonus depreciation. Are you able to share any examples of just how massive it is? Sometimes it's a lot easier to understand this stuff with numbers. So just the impact of that cost segregation study that can help somebody offset their taxes.
Absolutely. Well, I'll give you a quick example. Let's say you bought $1 million property. Let's just use the short-term rental example because we've been using that. We're talking about that and talking about the advantages that even someone with a W-2 can use that. The great thing about depreciation in general is that it goes after the purchase price and not off of how much money you actually put in. So you may be able to buy a property for $1 million with only 10% down or 20% down payment, which means you're putting in, $100,000, $200,000 into buying that property. Now let's say we do a cost segregation study. We always have to take off a certain amount for land, and it depends on where the property is located, what that land value is. The average is around 15% in the country, but in places where a lot of people have short-term rentals, like the Smoky Mountains of Tennessee, for example, is a very popular vacation rental place. The average there is about 8 or 9%, but let's just keep it round numbers, 10%, just to keep it simple. Let's say you took off 10% for land, meaning you bought this property for $1 million, take off 10% for land, we're left with $900,000 that we could depreciate. So just to understand this, if you did not do cost segregation at all, and you just did what's called the straight line depreciation method, you're going to divide that by 39 years, okay, the $900,000, because remember, even though I said that residential properties depreciate over 27.5-year schedule, but short-term rentals are considered commercial for depreciation purposes. So we're going to divide that by 39, and you're going to be about $23,000 a year. Okay, so simply put, $23,000, that's your income tax deduction, which means you deduct that from your income tax and you're going to pay that much less. Now, we do a cost segregation study and say we find 25% of that $900,000 in the faster depreciation. That's $180,000. Okay, that's a huge amount. Actually, that's more than that. 1 second. My math is not working right now for a second. 25%. Sorry, it's $225,000. Much better. 20% would be 180. $220,000 that you can now, with 100% bonus depreciation, you can now reduce that from your tax liability. So again, that's more than $200,000 difference between the regular deduction versus using the cost segregation. And you mentioned earlier, it's very expensive to get this done. It's all relative. We charge about $3,000 for single families. It can be up to $5,000, $6,000 for commercial properties. But that's not a lot when you're talking about the after-tax benefit, especially given the fact that expense itself is a write-off. it's really, I think, the numbers.
Yeah, I mean,
speak for
it's
itself.
phenomenal. When I heard about this, I was, all cost segregation. But we talked about the fact that bonus depreciation is going away, right? The real magic of cost segregation was when we had 100% bonus depreciation. I think even at 80%, it's still good.
Yeah.
But what do you see in the future? I mean, this is something that was built into the tax code per se, the cost segregation. How do you see it applying practically to, say, somebody, who buys property this year or maybe next year? They're not ready yet, and have they really missed out on something, or is there some way that they can still leverage, the tax deductions?
It's going to be less. I'll be honest, right? It's going to be less because cost segregation has been around for years and has always been a great benefit. It's been around for decades, I should say. But the real benefit for smaller properties is going to be tangibly less because the bonus depreciation, the 100% bonus depreciation was a big push for smaller properties. Meaning, previously, I used to say before there was bonus depreciation, it made sense a property purchase for over $500,000. Once there was 100% bonus, I would say even $200,000 property because again you're getting that huge lump sum in the first year. I think it's going to go back, right? It's going to start phasing back out and say it's not going to be really worth it to do on a smaller property just because the tax benefits.
Right. So it's going to be more towards like larger assets. If you're buying a much bigger asset or as you grow your portfolio, that's when this cost segregation really comes into play and sort of accelerates your growth and accelerates the cash that you're bringing back in from your tax savings. It may not necessarily apply right at the get-go, but as you start buying more expensive properties, that's when the beauty of cost segregation will kick in.
Yeah, I mean, they say it's not about how much you make; it's about how much you keep. If you like you said, it's a way to help you scale and accelerate your growth because by paying less tax now, and you can reinvest that money, help to buy another property. I know many people who have literally had the tax savings and use those tax savings to reinvest and buy another property.
Absolutely, and that's how you accelerate wealth. Well, how is it conducted really? What do you do when you're doing a cost segregation study? Do you need to visit the property or how do you do it?
So it's an engineering study of a property, which means we're looking at it. We have a full team of engineers that are either going physically to the property or seeing the property with a video call, a virtual study, we call it. And what they're doing is walking through and essentially measuring and taking pictures of everything. And then applying, as I mentioned, each and every individual component has a different value and has a different lifespan. And so we're identifying what those are and then breaking it down into a 90, 100-page report, which gives every line item and a very detailed calculation of how we get to those values of all those individual components, and then add that up, and that gets you your new depreciation schedule, which is essentially a one page, which you show your accountant, and those are the numbers you can apply to your.
And what's the deadline for this? Of course, business taxes are filed, in March. Is it supposed to be done before March, or is it supposed to be done before the closing of the financial year?
So it can be done. It does not need to be done in the calendar year. It just needs to be done before you file your taxes. So whether that's March for business taxes or April for personal, or if you're on extension, right, September, October. Right now we're in September. People on their extension on their personal income tax return for October 15th are still getting it done right now from 2022. So yeah, so it does not need to be done before the end.
What advice will you give for people who are considering this as to where they can learn more about cost segregation, how it's done, and how to vet the right person to? I mean, of course, we would love for people to come to you, but say they want to kind of vet people who are doing cost segregation. There are so many experts out there, right? How do you vet which one to go with?
There are, yeah. It's really important. I wish there was more information out there. Obviously you can search Google and you can find stuff like that. But there are, I think, a few essential things that you want to look for when you're finding someone to do cost segregation. First and foremost, you should speak to your CPA, right? You should speak to your accountant. 99% of CPAs do not do cost segregation in-house because it does require the engineering component, so they will need to use a third party. However, they'll give you the advice and hopefully they'll point you in the right direction. And perhaps they'll give you their opinion whether you should be doing it for your taxes or not. Because like I said earlier, this is a tax strategy. It works for some people, but doesn't for others. But the other things, once you do speak to your CPA, you want to look for a company that has audit protection, meaning, God forbid, if you're ever audited, you want to make sure that it's going to hold up and stand up in the eyes of the IRS. So you want to make sure that that company's been around for quite a while, has a lot of experience, and has experience in doing that as well.
Okay. All right. That's very helpful. Any final thoughts before we part?
Yeah, I would just say, continue your education because listening to podcasts like this is amazing. And there's so much value out there. And I guarantee you there are plenty of people who are listening to this that they had never heard of cost segregation before and may have to replay this to understand it a little more, but that's fine. And there are so many other little tiny things and niches in real estate investing that can help you grow your wealth as well. So keep educating yourself, keep learning, and
thank you so much, Yonah, for joining me. And guys, if you want to check out another episode on how to do tax, thank you so much, Yonah, for joining me for this episode. Guys, if you want to check out more about tax strategies, I actually got my tax strategist on this podcast to talk about specific tax strategies in real estate. You can check it out over here.